The stock market just hit its 23rd record high this year. Home prices are cresting higher than ever before. By the strict numbers, this is one of the wealthiest moments in the country's history. The average 401k balance recently crossed a record high of over $160,000, serving as the ultimate statistical proof of that wealth. However, consumer sentiment has dropped to the lowest level ever recorded, lower than the 2008 financial crisis or the pandemic. And while average retirement balances hit a peak, a record number of people are cashing them out early, paying massive penalties to avoid eviction. The disconnect between booming headlines and day-to-day financial struggle is a measurable mathematical reality. The average economy is a statistical illusion. Understanding the actual state of the country requires dismantling the aggregate data to see where the money is actually going. Trillions of dollars generated by a climbing market flow directly into specific pre-existing accounts rather than circulating through the general population. Of America's 134 million households, the richest 10% own 87% of all stocks. The bottom half owns just 1%. Thus, a 16% market return yields the bottom half $2,000, while handing the top 10% nearly $100,000. Mere participation in the market through a small retirement account is fundamentally different from meaningful ownership. For most workers, record highs are functionally irrelevant. Since the market isn't lifting the bottom half of the country, we must look at the daily mechanics of the average wage earner. The current labor market has become a mathematical trap. While average hourly earnings rose 3.6% last year, inflation hit 3.8%, consuming the raise before it ever reached a wallet. Americans are bridging this gap by borrowing from the future. Total credit card debt has reached a record $1.25 trillion, with average interest rates sitting near 23%. Credit counselors define this as survival debt. A third of those carrying these balances cite day-to-day expenses as the primary reason for their debt. Millions are now splitting grocery bills into 4 installment payments through buy now, pay later services just to get through the week. This has led to the collapse of the financial safety net. For the bottom 50% of the country, the savings rate is now negative. Running a structural monthly loss means half the country is actively sinking into debt to cover their basic needs. The old model of a K-shaped recovery fails to capture the 3 distinct, disconnected realities of the modern economy. An accurate model is the E-shaped economy, which consists of 3 horizontal bars representing different classes. The top bar is the ownership class. Their wealth lives in stocks and real estate, both of which have been on a tear, causing this bar to stretch far past the others. The bottom bar is the bottom half of the country. These households are stuck at the floor, excluded from asset gains and drowning in survival debt. The middle bar is the middle 40%. This bar slopes downward as inflation erodes their purchasing power, forcing them away from premium brands and toward discount retailers just to stay afloat. Right now, the entire country is fraying under the strain of these 3 realities pulling away from each other. Adding the wealth of these 3 groups together creates a booming average on a chart, but that number hides the catastrophic inequality underneath. When the next round of economic data claims the country is booming, follow the math and look at the distribution. Ask, booming for who?